Hey everyone, Alex G here, and welcome back to the channel. For those of you who are new here, I'm Alex, and on this channel I break down everything related to world economy and personal finance to help you make smarter decisions with your money. If you want to stay updated on the biggest economic shifts, market movements, and financial strategies that actually matter, make sure you hit that subscribe button and turn on notifications right now. And if you've been rocking with me for a while, drop OG Alex G in the comments so I can show you some love. Now let's get into today's topic because what I'm about to share with you is absolutely massive. We're talking about a perfect storm that's brewing in the global financial system right now. Gold just shattered the $5,000 per ounce barrier for the first time in human history, and at the exact same time, Japan's bond market is experiencing what financial experts are calling the worst crisis since the 1990s. And here's the kicker. This isn't just happening in isolation. These two events are connected in ways that could fundamentally reshape the global economy and directly impact your wallet, whether you realize it or not. So grab your coffee, settle in, and let me break down what's really happening, why Wall Street is panicking behind closed doors, and most importantly, what you need to do right now to protect and potentially grow your wealth during this crisis. Let's start with a headline that's got everyone talking: gold hitting $5,000 per ounce. Now, I know some of you might be thinking, Alex, gold has been going up for a while now, what's the big deal? But trust me, this is different. This is historic. As of today, January 26, 2026, gold is trading at 5,085 per troy ounce. That's a 1.95% increase just from yesterday. And if we zoom out, we're looking at a 17% surge in just the past month alone. Year over year, we're up a staggering 85%. Let me put that into perspective for you. If you had invested $10,000 in gold 1 year ago, you'd be sitting on $18,500 right now. That's an $8,500 profit in 12 months. But here's what's really important to understand. Gold isn't rising because the economy is doing great. Gold is rising because the economy is signaling serious trouble ahead. Gold is what we call a safe haven asset. When investors lose confidence in stocks, bonds, currencies, or governments themselves, they flee to gold. It's been that way for thousands of years, and it's happening again right now on a massive scale. This week alone, gold is on track for its strongest weekly performance since March 2020. And if you remember March 2020, that was right when COVID hit and the entire global economy basically shut down overnight. The fact that we're seeing similar moves now should tell you everything you need to know about how serious the current situation is. Now, major investment banks are scrambling to update their forecasts. JP Morgan had predicted gold would hit $5,000 by the fourth quarter of 2026. Well, we got there in January. Some analysts at Yardeni Research are now saying we could see $6,000 by the end of this year, with $10,000 being a real possibility by 2030. And honestly, based on what's happening right now, I wouldn't bet against those predictions. Now let's talk about what's happening in Japan, because this is where things get really interesting and really scary at the same time. Japan just experienced what Bloomberg is calling a historic bond market sell-off. And when I say historic, I mean the kind of event that finance textbooks will be written about. Here's what happened. Japan's 40-year bond yields just surpassed 4% for the first time since 2007. Their 30-year yields hit 3.15%, which is a record since these bonds were first issued back in 1999. Now, if you're not a bond expert, let me explain why this matters. When bond yields go up, that means bond prices are going down. And when bond prices go down rapidly, that means investors are panic selling. They're running for the exits. So why is everyone selling Japanese bonds? It all started when Prime Minister Sanae Takaichi announced snap elections and unveiled a massive spending plan that includes abolishing the food sales tax and other expensive programs. The total package is worth about 21.5 trillion yen. That's roughly $145 billion US dollars. And here's the problem. There's no clear plan for how to pay for it. Japan is already drowning in debt. Their debt to GDP ratio is hovering near 240%, which is the highest in the entire developed world. To put that in perspective, if Japan's economy produces $100 of value, their government owes $240. That's simply unsustainable. And now the government wants to spend even more money they don't have, which means they'll need to issue even more bonds, which means even more debt piling up on top of an already massive mountain of debt. Investors looked at this situation and said, you know what, I don't want to hold these bonds anymore. This is too risky. And when everyone tries to sell at the same time, you get what we're seeing now, a full-blown crisis. The Bank of Japan tried to step in and calm things down by buying bonds, but the market isn't buying it. Literally. The panic continued even after intervention, which tells you just how serious this situation has become. Now here's where everything connects, and this is the part that should really have your attention because it affects every single person watching this video, especially if you're American or if you hold US dollars. Japan is the largest foreign holder of US Treasury bonds. As of November 2025, Japanese entities held about $1.2 trillion in US Treasury securities. That's trillion with a T. That's more than any other country in the world. Now, recent data shows that Japan actually increased their holdings to 1.13 trillion in March 2025, so they haven't started dumping US bonds yet. But here's the critical question: what happens if they need to? Let me explain the mechanics of this. For decades, Japan has been buying US Treasury bonds as a safe investment. Japanese interest rates were basically zero or even negative for years, so Japanese investors and institutions would borrow cheap yen and invest in US Treasuries that paid higher yields. This is called the carry trade, and it's been one of the biggest trades in global finance for the past 20 years. But now Japanese bond yields are rising rapidly. If you're a Japanese investor and you can suddenly get 3% or 4% by investing in your own government's bonds, why would you keep your money in US Treasuries that might only pay you 4.5%? The difference isn't worth the currency risk and the hassle. So what happens next? Japanese investors might start pulling money out of US Treasuries and bringing it back home to invest in Japanese bonds. This is called repatriation. And if this happens on a large scale, it creates massive problems for the US. First, if Japan starts selling US Treasuries, that pushes US Treasury prices down and yields up. Higher yields mean higher borrowing costs for the US government, which means bigger deficits, which means more debt. It's a vicious cycle. Second, if Japanese investors need to convert their dollars back to yen to invest in Japan, that creates selling pressure on the US dollar. More dollars for sale means a weaker dollar. A weaker dollar means inflation in the US because all our imports become more expensive. And here's the kicker that nobody's really talking about. Japan isn't the only country in this situation. China, South Korea, Taiwan, and other Asian countries all hold massive amounts of US Treasuries. If they see Japan pulling out and they get worried about their own holdings losing value, they might start selling too. That's when you get a real crisis, a loss of confidence in US debt and the US dollar itself. Now, as if all of this wasn't enough, we've got serious geopolitical tensions adding fuel to the fire. And this is exactly why gold is surging right now. President Trump just announced that the US would seek sovereignty over parts of Greenland that host American military bases. This has upset Denmark and the entire European Union. He also threatened Canada with 100% tariffs on all exports if they finalize a trade deal with China. Think about what that means. Every car part, every piece of lumber, every barrel of oil coming from Canada could suddenly cost twice as much. Meanwhile, US brokered talks between Russia and Ukraine just ended with no breakthrough. They agreed to meet again next weekend, but right now there's no peace deal in sight, which means continued instability in Europe, continued pressure on energy markets, and continued uncertainty for global trade. All of this uncertainty is pushing investors toward gold. When you don't know if there's going to be a trade war, when you don't know if there's going to be a currency crisis, when you don't know if governments are going to be able to pay their debts, you buy gold. It's the ultimate insurance policy, and central banks around the world are doing exactly that. They're buying gold at a pace we haven't seen in decades. Why? Because they're diversifying away from dollars and other currencies. They see the same risks we're talking about, and they're preparing for a potential crisis in the global financial system. All right, so we've covered what's happening and why it's happening. Now let's talk about what really matters. What does all of this mean for you and your money? First, understand that we're entering a period of significant financial uncertainty. The old rules might not apply anymore. The strategies that worked for the past 10 or 15 years might not work going forward. You need to be prepared for volatility, for surprises, and for rapid changes in the markets. Second, diversification is more important than ever. If you're 100% invested in stocks, especially US stocks, you're taking on enormous risk right now. If the dollar weakens significantly, or if we see a broader market correction, you could see your portfolio lose 20%, 30%, or even more of its value in a very short time. And this is exactly why so many sophisticated investors are moving into gold and other precious metals. They're not doing it because they think gold is going to the moon. They're doing it because they want to preserve their wealth during a period of uncertainty. Gold doesn't pay dividends, it doesn't grow earnings, but it also doesn't go bankrupt. It can't be printed by central banks, and it's maintained its value for thousands of years. Now, I'm not telling you to go all in on gold. That would be just as risky as being all in on anything else. But having 5% to 15% of your portfolio in gold or gold-related assets makes sense as insurance against the kinds of scenarios we're discussing today. You should also be thinking about other hard assets, real estate and stable markets, commodities, even cryptocurrency, for those of you who are comfortable with that level of risk and volatility. The key is spreading your risk across different asset classes that don't all move together. Third, if you have significant dollar-denominated savings or investments, you might want to consider some currency diversification. I'm not saying sell all your dollars and buy euros or yen, but having some exposure to other currencies, maybe through international funds or foreign bonds, can help protect you if the dollar weakens significantly. Fourth, be very careful with debt right now. If we enter a period of high inflation because of a weakening dollar, interest rates could spike even higher than they already are. If you've got variable rate debt or you're thinking about taking on new debt, be very cautious. Lock in fixed rates if you can, and try to pay down high interest debt as quickly as possible. Let me give you some specific things to watch for over the coming weeks and months, because this situation is going to continue developing. First, watch the Federal Reserve's meeting on January 28th. That's just 2 days away. If the Fed signals that they're worried about financial stability, or if they hint at potential intervention in bond markets, that's going to move markets in a big way. On the flip side, if they sound complacent or dismissive of these risks, that could actually make things worse, because markets will lose confidence in the Fed's ability to manage the situation. Second, watch the yen-dollar exchange rate. If the yen starts strengthening rapidly against the dollar, that's a sign that Japanese investors are bringing money home and that the carry trade is unwinding faster than expected. That would be a red flag for potential market turbulence ahead. Third, watch US Treasury yields, especially the 10-year yield. If we see it spike above 5%, that's going to cause serious problems for everything from mortgage rates to stock valuations to government borrowing costs. Right now it's hovering around 4.5%, so we're not far from that critical level. Fourth, keep an eye on gold itself. If gold consolidates around $5,000 or pulls back a bit, that might be a good buying opportunity for those looking to add some to their portfolio. But if gold shoots up to $500 or $6,000 very quickly, that's actually a warning sign that investors are in full panic mode about something even bigger that might be coming. Fifth, watch China's actions. If China starts reducing its US Treasury holdings or making moves to strengthen the yuan against the dollar, that would confirm that we're seeing a coordinated shift away from dollar dominance. That would be a massive, massive development. Here's what I think is really happening at a macro level, and this is just my opinion based on years of studying financial markets and economic history. We're potentially witnessing the beginning of a significant shift in the global financial order. For the past 80 years, since the end of World War II, the US dollar has been the world's reserve currency. That's given America enormous advantages. We can print money, and the whole world has to accept it. We can borrow at lower rates than anyone else, and we can run trade deficits that would destroy other countries. But that privileged position was never guaranteed to last forever, and the combination of massive US debt, political instability, and the rise of alternative powers like China means that the dollar's dominance is being questioned like never before. What we're seeing with Japan's bond crisis and gold surge might be early warning signs that the transition away from dollar dominance is accelerating. I'm not saying the dollar is going to collapse next week or next month, but over the next 5 to 10 years, we could see a world where the dollar is just one of several major reserve currencies, rather than the dominant one. If that happens, it's going to change everything about how the global economy works. Countries won't need to hold as many dollars. The US won't be able to borrow as cheaply. American consumers won't be able to import goods as cheaply as we do now. And assets like gold, which aren't tied to any particular country or currency, are going to become even more valuable as a neutral store of wealth. Look, I know this is heavy stuff. I know it can feel overwhelming when you're hearing about bond market crises and currency risks and geopolitical tensions all at once. But here's the thing. Knowledge is power. The fact that you're here watching this video means you're already ahead of 95% of people who have no idea any of this is happening. The worst thing you can do right now is stick your head in the sand and hope everything works out. The second worst thing you can do is panic and make emotional decisions. The smart play is to stay informed, understand the risks, and position yourself accordingly. Gold at $5,000 isn't just a number. It's the market screaming that something fundamental is changing. Japan's bond crisis isn't just a problem for Japan. It's potentially the first domino in a much larger chain of events. And the questions about the US dollar aren't going away. They're only going to get louder. So take action. Review your portfolio. Talk to a financial advisor if you have one. Do your own research. Make sure you're not overly concentrated in any one asset class or currency. Build some insurance into your financial plan through hard assets and diversification. And most importantly, stay tuned to this channel because I'm going to be covering every major development as this situation unfolds. This is going to be one of the biggest financial stories of 2026, and we're only in January. If you found this video valuable, smash that like button. If you want to make sure you don't miss my next video, subscribe and hit the notification bell. Drop a comment below and let me know what you think about all of this. Are you worried about the dollar? Are you buying gold? Are you changing your investment strategy? I read every comment and I love hearing your perspectives. And if you really want to dive deeper into financial education and smart money strategies, check out my other videos. I've got playlists covering everything from basic investing to advanced market analysis. This is Alex G, reminding you to stay informed, stay smart, and take control of your financial future. I'll see you in the next one.